Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, founder of Menninger Associates Financial Planning. I like to be an educational TV show, hopefully a little bit entertaining at the same time. And we like to be talking about topics on financial planning. Imagine that, the name of the show. I'm a firm believer, and I try to propagate it to everybody within my firm, that education and knowledge are powerful. And we've received a tremendous amount of feedback with regards to our shows that they like when we do the Q&A. Because the Q&A, the questions and answers, when we do it, we're talking about topics that are really common questions that people ask or experience, or their friends might ask or experience. So we're continuing on with that. And I also have two of my associates here. I got Kyle Ryan to my immediate right, also a certified financial planner, and all the way to the right is Ryan Keefe, and he's been with me for 5 years now. Just seems like 20. So thanks for joining me again, guys. This is great. We're going to jump right in and get into these questions. Again, you look at the financial planning, you got the cash management, tax planning, the risk management, life insurance planning, you got investment planning, retirement planning, and estate planning, and they're all seem to be very integrated. So when we're meeting with clients, a lot of times they ask us a question that may be associated with one particular topic, but little do they realize, because everything is so integrated, that it really impacts almost every other area. But aside from all that, what we're going to do is we're going to jump in and pick up and start answering some more questions. So what's our first question of the day? How can I help my child establish credit while they're still in school? Okay, relatively simple question. This one shouldn't take us an entire 20 minutes.
Yeah, we'll see.
Then again, it wouldn't be anything could take 20 minutes, right?
Yeah.
You guys deal with this all the time. You have some good ideas.
Yeah, I would say it's really important not to undermine the importance of understanding how your credit works, how your credit score is impacted by different decisions you make. So when, specifically the question is when they're in school, so there's a couple different ways you can do it. You can get, my longest lasting line of credit is my student loan, right? So that's the first one you get. That immediately establishes credit, is having loans in your child's name.
Paying loans, not just having loans.
Oh, having having the loan, the length of my credit, as long as it goes, is as soon as I got my loan, I had a credit history. Okay. Even though you're not paying it, it doesn't help as much as when you're paying them.
Right.
But having a loan, having a credit card, having something in your name. You know, I've talked to people who open up a credit card in their kid's name. They just use it for gas, groceries. Right. You know, they just pay it off monthly, and it's immediately building.
That's correct.
Yeah.
That's correct.
Yep.
And so one of the things on that note is credit is very important, because, you know, you figure you need credit in order to buy stuff.
Whether you like it or not.
Rent. You guys have to deal with that when they're asking for your, you know, they check your credit for when you want to rent. Buying a home, buying a car. Although the dealerships, they just want to make sure that you're buying a car, but that's a separate issue. But one of the things that I came across is no credit is just as bad as bad credit almost.
Oh gosh, yeah. Credit ghosts.
So I actually had a client had to co-sign a loan for their 28-year-old son for the mortgage. It's not because the 28-year-old son had bad credit. He had no credit. You know, because people are like, well, I'll just pay cash. I don't want to have a credit card, blah, blah, blah. They have no credit. Mm-hmm. And so that's actually just as bad. And so he's like, okay, well, what's the difference? Well, I'll tell you, there's a huge difference. Mm-hmm. The difference between having good credit and bad credit can make the difference of either being able to get what you want and not get what you want, but paying more for it.
Way more.
Especially for the mortgage. If you take a look at a mortgage, because it's stretched out over 30 years, the difference between 1%, he's like, what's 1%? 1%, tens of thousands of dollars over the life of the loan.
I had a personal experience. I was buying a car at the same time a friend of mine was. I had good credit. He had very little to bad credit. And when I went to buy my car, 2% interest rate. His was 7.
Sure.
It's a dramatic. It can be very dramatic. Not always that big, but
Oh,
it
that's
makes,
that. It can be that dramatic. And so, I like to use the anecdote of my son. When he was in college, what I did is I had him get a credit card, and then he subsequently got a second credit card. And I had committed to paying for his school, and his school wasn't that much money. So, what I also did during the course of it is I took out 2 separate Sallie Mae loans. Now, trust me when I tell you, it burned me to be paying 7.5% interest on this Sallie Mae loan, but it was only $3,000. And I figured over the span, what I did is I expedited payment on each of the 2 loans, and in effect, it cost me on each loan about $150 in interest. Okay, I hated paying $150, but at the end of the day, he ended up graduating college with a 786 credit score. You get a decent job with decent credit, guess what? You can.
The world's yours.
That's right.
Yeah. Go ahead.
and one of the things that I've run into is a lot of people don't know even how to check their credit, let alone. And you want to know your credit score before you're going to, see if you apply for a mortgage or qualify for a mortgage, qualify for your rent. You want to know what that score is, and there's tools out there, websites that can help you not only know what your credit is, but what your weak points are, and what really affects your credit. What's a major impact to your credit score, like missing payments, versus an average one, which is the lifespan of your credit, which if you're just starting is always going to be
Short. That's right.
But you don't want to cancel cards that you've had for a long time, even if there's no
Right.
balance on them. You want there's a lot of nuances to.
Yeah, I had that issue happen to me where I had to cancel a card that I had for a long time, since 1984, and had to cancel it through divorce. But I was like bummed because there goes that really long one. So the 3 credit agencies are TransUnion, Experian, and Equifax. Not to mention, we strongly encourage people to check their credit periodically, because it's amazing what garbage could be on your credit score that you have no idea. In fact, especially if you have a child or a parent who has the same name.
Yeah.
Junior, senior type of arrangement. And, all of a sudden something of theirs may be on your credit score, or quite honestly, you could have something on there that's incorrect.
Yeah.
And I've heard people say, holy smokes, I have a $150 cable bill from 3 years ago that I didn't even know about. And they take it off, and they basically paid the $150. They'll either, sometimes it's not worth fighting it, but they pay the bill, poof, it goes off, their credit jumps 50, 60 points. It's amazing what, so it's a great question that leads us into some of the other things. Right. All right, so what's our next question? For those who have better eyesight than me.
I have a modest savings, but I want to be better prepared in case of a financial emergency. What are some ways I can accomplish this?
Okay. Well, there's a lot of different ways. You guys want to tackle that one?
Yeah, I mean, in general, there's rule of thumbs as to the amount that one should have in an emergency savings fund. Depending on whether you're married or not, depending on whether you have other resources to go to for money. But generally, they say to have 3 to 6 months of emergency funds. Now,
3 to 6 months of expenses.
Of expenses,
Correct.
meaning, and what are those expenses? It's the ones that you can't go without, the
Right.
payments you have to make.
Rent, car payment, food.
Yeah.
You
Yeah, so you want to make sure you have 3 months of liquid cash that you're accessible to in case you lose a job, you get disabled, something happens and you need to pay for it. So generally having that, but like we've mentioned before, home equity line of credit is one of the many tools that you can have to, your cash is earning you very little, so why not put it to use it on debts, and have a home equity line of credit act as your emergency reserve.
Correct. And and it obviously only works if you have a home and you have enough equity in your home to be able to do it. But most banks will also give you a $10,000
personal line of credit.
Right, a personal line of credit. Now, of course, it may not be the best terms. It might be 8%, 9%, 10%, but it's an emergency reserve. And cannot stress enough the emergency reserves of being at least able to access. And in fact, you really always have a 30-day emergency reserve in the form of a credit card, as long as you manage it properly.
Yeah.
Okay, if you have to put something on the credit card because you don't have the cash, that gives you 15 or 30 or 45 days to figure out how in the world am I going to pay this thing off.
Yep.
Now, if you don't own your home, so you can't get access to a home equity line of credit, and you don't have the cash sitting in your savings account, one of the other tools you have available to you is your retirement plan. Usually 401ks have loan provisions at your work. You should understand and know those provisions.
Yep.
But usually you can borrow up to 50% of the total balance of the account, the vested balance of
Up
the
to
account.
50,000.
Up to 50,000. That has to be repaid over a certain term, and that comes
to
out
5
of
years, yeah.
and that comes out of your paycheck. The nice thing about that is at least the interest that accrues on that loan, you're paying back to yourself.
Correct.
So
Beautiful.
You're losing the ability to have the investments grow, but at the end of the day, it's not the best place to go, but it is a place to go. And, there are going to be times during people's lifetime that they're going to be in a pinch. The downside of losing your job and having your 401k loan is you're at the risk of, let's say I have $20,000 remaining on my 401k loan. I'm at the risk of that money's due immediately.
Yeah.
And obviously it's coming at a really crummy time
Right.
if you just lost your job. So they're not going to make you come up with the 20 grand.
Just take it from your existing assets.
Well, what'll happen is that
You get a
you get a 1099 for 20 grand that you're going to pay taxes as if you took it out.
Yep.
And then you'll pay a penalty if you're under age 59 and a half. It's not always necessarily, and there's a lot of people who say it's a horrible way to go, and I do agree to a great extent, but if you're in a pinch,
Yeah, if you need money, you need money.
how much can I get for my kids? All right, that was probably inappropriate, but then again,
That's what it is.
I'll sell you guys then.
Yeah, there you go.
There you go.
All right, what's our next question? Oh man, is that a loaded question? What is the most important component of my financial plan? Okay.
Setting it.
I like that. Good answer.
Yeah.
Doing one.
That's probably the most. You can't have an important component without having one,
Yes,
right?
I'll give you that. I'll give you that. Yeah, well, you know what? Which really starts with goals.
Of course.
Having real, I say accurate, but
Tangible.
understandable,
Yeah.
tangible, that's a good word. Tangible goals. And willingness to follow it. And, so in the prior episode, the question was, when should I start retirement planning? We really went off on that. But a lot of the most important component of the financial plan, if it is associated with retirement, is understanding your cost of living. And so we do enough financial plans for clients that it is absolutely remarkable what just $500 or $1,000 a month can mean in retirement and the success of being able to retire comfortably. So somebody who says, well, I need to live on $6,000 a month, the difference between $6,000 a month and $5,000 a month and $7,000 a month is unbelievable as far as the chances for success of that particular retirement plan.
And I know we're up against break, but two factors that I find have a profound impact on financial plans that a lot of people don't consider right off the bat. One being inflation, which they might start considering after this year.
Yeah, right.
And the rates of return on your investment.
That is also correct.
Those are two very important facets that are going to both grow your assets and grow your expenses.
Right, that is correct.
That need to be taken into consideration.
That is correct, and I'm glad you put that up, because people don't take into account inflation, and if they put all their money into savings accounts, by definition, a savings account is always going to lag inflation.
Right.
And that's the one thing about investments. Investments are considered to be an inflation hedge. So, thanks for pointing that out.
Yeah.
So we're up against break. So please stay tuned, and we'll be back with you in just a few moments.
Have you saved enough for retirement? Are you financially prepared for an emergency or unexpected event? Have you thought about your financial future?
Hi, I'm Mike Menninger, founder of Menninger Associates Financial Planning. For over 20 years, we have been answering our clients' questions just like these as we develop unique and comprehensive financial plans tailored to meet their needs. when addressing your financial plan, we incorporate your entire financial picture, including taxes, estate planning, as well as investment planning and retirement planning. So call us today for a complimentary, no obligation consultation. Welcome back to Financial Plan and Explained. I'm Mike Menninger, host, certified financial planner. Kyle, you answered or pointed up something during break. One of the most important concepts of a financial plan, and
Yeah, I'd say it's really your commitment to it. I mean, we've all, as advisors, come across it. You know, there's an old adage where, you know, you can lead a horse to water, but you can't make him drink it. And there's a lot of times where, you know, you can tell someone what might be the most efficient way to get something done. But again, there's a lot of our job is psychological and behavioral based. So you can tell someone that, you know, you need to pay yourself first, or we recommend you pay yourself first, but you need to send in money quarterly for taxes. You need to do X, Y, and Z, and it just doesn't sit right. So that's why education is so important, because if it doesn't sit right with them, they're not going to do it, and that's why your own commitment is the most important component to your financial plan.
yeah, there's no doubt about it. No, that was a very important. You're going to say something?
I mean, the thing that I was just kind of thinking about with in regards to that was, when it comes to your financial plan, the one thing that you're really going to want to try to build into the plan is flexibility.
Yes.
And that's what we try to do
you know
as
what?
financial planners.
That's a good point.
Glad you brought that up.
Because the one thing we can never guarantee or predict is that life is just
Yeah, the only thing you can't guarantee about life is nothing's guaranteed.
No guarantees.
Exactly.
so you want to have the most flexibility
Absolutely.
at your disposal.
Which we try to create when developing financial plans. And the other thing is, a lot of times, again, to your point of it's emotional, people don't want to meet with or work with a financial planner because they fear that we're going to put them on a budget. Mm-hmm. And you know, the big B word, budget. The reality of it is that we're not putting people on a budget. We're going off of what they said their cost of living is going to be. And that's why in one of the earlier questions, it was important to understand or start working a few years on your financial plan before you retire, because that helps you better understand what your cost of living is. I don't want to tell you your financial plan says you can live on $5,000, you're on a budget.
Yeah.
We need to do is establish what your cost of living is, and if your financial plan doesn't allow for it, then it becomes a value judgment and a prioritization that every single one of our clients has to do. And I tell people, unless you have money spilling out of your pockets with more money than you'll ever need, and I'm sorry, Mr. and Mrs. Client, but I don't see a trail of bills between the door and the conference room. The most important thing you can do, or it's not so, you got to understand the prioritization, okay? I can't tell you what to do. Your financial plan says that you can live on X number of dollars. If you can't meet it, then it's very simple. We all have this problem in life. We have $10 worth of goals and $7 in our pocket. Therefore, we need to make priorities. And the priorities may be, hey, you know what? If you still want to live on that $10, well, then you might have to work 3 more years. Or it may be, guess what? I only have a $7. What I'm going to do is, instead of going out to dinner 2 times a week, I'm going to go 1 time a week. Instead of this, I'm going to sacrifice and supplement it or replace it with this. But we all experience life is full of priorities and, you know, making decisions, because almost every decision you make impacts another one.
Oh, absolutely.
Yeah, we're all sharing the same few bucks.
Yep.
Yep.
All right, what's our next question? What is the most important component? Oh, that was the last question. All right, so.
The next question is, I want to understand my cost of living better. What are some ways in which I can do so?
Oh, okay.
which kind of
Which is
fits
dovetailing on right we were
fits
just
pretty
talking
well,
about.
yeah.
Okay.
Yep.
So you can do it the hard way?
You can do it the Mike way or the easy way.
Right, exactly. Okay, I will tell you, there are a handful of ways that you can do it.
Absolutely.
Okay, you guys are the young guys. You got the technology out there to do it. Okay, we actually have a technology that we use for our financial planning, and that same technology enables the clients to be able to link their bank accounts, their credit cards, and everything to it, which will actually track all of their expenditures. And from there, it enables them to even categorize it. Okay? There are public ones, I've heard mint.com, that basically does the same thing as that particular software. There are alternative ways that, believe it or not, we use all the time. Well, not believe it or not, you guys know it because you do it with me. Is we say to Mr. and Mrs. Client, I want you to take 2 defined periods of time. We're going to, let's say, look at January 1st of last year to December 31st of last year. And we're going to look at your bank statements. Now, if your bank statements say that your savings account went from $10,000 to $15,000, you saved $5,000 last year. Then what we look at is we look at how much income you had. And I'm not talking about, well, my gross income is $100,000. No. And you're saving money to your 401k and you're paying for medical, you got all these taxes coming out and everything else. But your paycheck is $2,000 every 2 weeks. Okay, so if your paycheck is $2,000 every 2 weeks, you can figure out from your bank accounts how much income you had. So if during the course of the year you had $80,000 worth of income and your savings account went up by $5,000, your cost of living is 75 grand. Now, I will tell you my experience is people immediate knee-jerk reaction. You say that's $6,000 a month. No way, I don't spend $6,000 a month. I think the proof is in the pudding.
Where's it going?
Where's it going? And so there, that is a quick, and they get agitated by it. But it's like, before you get agitated, let's think about this. Did you have any one-time events last year? Okay, oh, that's right. I had my daughter's wedding. We spent $20,000. There you go. Hopefully your daughter's not going to get married several more times, okay? That's a one-time expense, okay? And so we could say, all right, instead of it being $75,000, it was really $55,000.
It's the interesting thing about one-time expenses, though.
Absolutely. And we've talked about this because I've had this happen with my mother, as well as multiple other clients. They say, this was a one-time expense. My porch needed to be repaired.
And then next year I needed a new car, and next
then
year
I
the
needed a new
driver
heater,
went, and then I
right.
got to get new carpets. And
Right, and and I was like, all right, you know what? I understand that was a $5,000 one-time event, but Mr. and Mrs. Client, every single year you've had these one-time events for $5,000. It's okay. It's understandable. There's this thing called life. Every year you're going to have a one-time event. You just got to assume we have $5,000 a year to your one-time events. And you just plan for it.
Yep.
And some people have vacations every year that find their way in there.
That's right.
But the thing that I know you've spoken to is when people track their expenses, usually the second highest expense every month next to the mortgage is miscellaneous.
Right.
It's all of this other stuff that you don't know where it goes, but somehow it adds up, and it's.
Well, I speak to that because of the fact that I did it the hard way. Okay?
Yeah.
This was before the days of all of these online things. Back in the 90s, I actually created a spreadsheet.
oh God, it's a
And
good one.
the spreadsheet, and I did it for a few years, it was remarkable. I literally tracked every dollar that left every single day. I would either take my credit card at the end of the month, slap it on there, or look at my checking, slap it on there, and any cash that I use, I would record a receipt. I had columns for the mortgage, the home equity line of credit, my car, my wife's car, gasoline, insurances, utilities, grocery stores, dining out, and to your point, the single largest column behind the mortgage, other. And that's discretionary spending. And it could have been gifts for this, it could have been just all these little things. One of the things that I've found through my years of planning is I will ask clients, so tell me what your cost of living is, and they'll create a detailed list. And rule of thumb, they're usually 30% short of what their actual cost of living is, which means they almost have to increase it by 50%, which is, there's no way. Oh, I could live on $6,000 a month and jump for joy. And next thing you know, all of a sudden, they're living on a whole lot. And that is, again, going back to one of the earlier questions, is we want to make sure that people really understand this because before they pull the trigger and retire, because oftentimes, once you retire, it's very difficult to unretire and get that same job back again, which means you're not going to be earning the same amount as you did before. So that's an important.
Yeah, and it goes back to us saying knowledge is powerful. Knowing how much you spend and where you spend it can have a huge impact on your financial
Exactly,
plan.
and it gives you the ability to understand what your cost of living is, because if there's certain costs that can be eliminated, well then, again, it goes back to the prioritization again. Your values, what's more important to you? Is it more important to you to be traveling? Okay, I'm not going to tell you not to travel, but if your cost of living allows you $75,000 a year, but your $20,000 traveling blows you out of the water, then you're either going to need to figure something out that you have to give up to do the traveling, or pare back on your traveling. Again, it's not our job to prioritize your expenses. It's our job to make you aware of it. And shoot the messenger, boy, I tell you what, I got a lot of bullet holes in this body. All right, what's our next question?
We got to wrap it up here.
Oh, do we?
Yeah.
All right. So I guess what? I just been yelled at. We got to wrap it up. So thank you very much again for following us through this episode. I hope through the discussion of some of the commonly asked questions that you were able to learn something. And until next time, I hope you join us for our next episode where we're going to be doing more questions and answers. And thank you for joining. And I hope you have a wonderful day and a wonderful rest of your week.